everyone. Thanks for being here. It's good to be back. And although you guys had a great time, no fall off in quality or fun, I listened into a lot of those spaces over the past 2 weeks. I'm really appreciative of Richard and Moritz doing such a good job, and I'm sure it'll happen again. But this is a new avenue that's open to us that we don't have to cancel. We got lots of good people who can hang in there and do a good job, keep the conversation going, and keep our fun going every Friday, 7 a.m. Eastern time. Um, but I had to go on vacation. It was 2 weeks in France. We had a really good time, and the wife was putting pressure on me. And it was the time zone too. I couldn't, middle of the day, difficult for me to break away from these fancy lunches or tours. I was in Versailles and south of France, Paris. So, I had to, couldn't, couldn't, I had to take some time off, which is always good. I felt a little recharged, energized. And I was on my phone a lot, you know, um, looking at the markets and talking to people. But in 2.5 weeks, I never charged my laptop. I was on my laptop. I just didn't use it very much. So it was a pretty good vacation. And oh, but guess what today is? Yep, today is her birthday. So today I wake up, she wants coffee, and I have to tell her, "Oh, I'm doing spaces today." And she's like, "On my birthday?" Yes, I drew the line right there. 2 weeks is enough. 2 weeks with her influencing my podcast and my spaces schedule. But even on her birthday, you guys took precedent. So got to make sure she knows where she stands. She's a little above the spaces, but not always. Later she got her coffee, but now we got to continue our tradition here and get down to work and get down to business and going over some of these fun tweets, these controversial tweets, these critical tweets. I like these things. I like people challenging trend following and us. We have the proper answers. And if we don't, we admit it. We talk about the pros and cons and the strengths and the weaknesses of trend following. We don't, it's fine when other people criticize. They don't have good criticisms, though. I wish the criticisms in the comments were better, more fact based, something that was really challenging, but they're not really all that great, to tell you the truth. So it's a little disappointing. But when we do get some pushback, it's always good to, because that's how I do business. I welcome criticism. There's been times on this spaces and the predecessor of a clubhouse where people pointed out mistakes and pointed out things that I was wrong about, or we are trend following that I hadn't really thought about, and I immediately embraced that and admitted to it. And sometimes I changed the way I was thinking and doing things because of that. So I welcome any and all of that, and so I'm never going to shy away from. That's just way too much fun to talk about some of these tweets. And one thing though, and I don't really enjoy a lot of criticism that is not intellectually based, but it's half-assed, it's personal, kind of personal, kind of taking cheap shots, and it's just not that much fun for me, and it'll kind of ruin my day or my hour. And so what I did is I figured out that Elon's getting rid of this blocking thing, which I'm not really that. I like blocking people if it's just a totally worthless situation. But so what I figured out I would do, and I don't want to block everybody. And some of these people, like Harris, he's my friend. I like him, but he has kind of decided he's going to take off and criticize us and write these articles. So I want to respond to them. I'm up to it. We're all up to it. So one of the things I decided to do was you can unfollow people and then choose to not allow people that you don't follow to comment. So that's helpful. I don't need his comments or people's comments. They're just consistently ignoring things we've already talked about. I dislike that. That's one of my biggest pet peeves is to get on these podcasts, talk to these people. We go over this stuff over and over. They have no answer for our comments and objections during the podcast or on the spaces. And then offline or in another podcast, I have to listen to crap as if we've never talked about it, retreaded, going over ground with nothing new. Come up with something new. or let's just say to each other, that's just something we don't agree with. So that's fine. But approaching these same topics over and over as if this bullshit stuff never was shot down before, and they continue to say it. I have never done that in my entire life. Have someone put me in my place and continue spouting it out as if I had never heard this before. It's just so frustrating. Okay, I can't promise we won't get any loud alarms going off in this spaces, but it was definitely handled by the algorithmic advantage host, and that was a couple of good podcasts as well. Really enjoyed those. Really fun listening to the Moritz's talk with Richard and his co-host. Yeah, that was fun. So, anyways, it's a long-winded, well, not too long-winded, just 6 minutes. Oleg, how are you doing?
Oh, hi Jerry, I'm happy you're back. Hi Maurice, hi Richard, hi Bruno, hi, hi all the guys. I still here with Marcel, Abuzan, Josh, Gardner, all the guys I see here. I always say that I'm happy to see you, and it's because it's truth. The only reason I say this is because it's totally 100% truth. So this only yesterday maybe, I was looking from the orange juice chart from maybe 1970s. I was watching this chart, doing some backtest, and I saw that there was no such trend as we see now, at least for 50 years. And I think that, of course, nobody could not predict this. Nobody could not do this. And I remember that how I was reading a book of Peter Thiel. I have mentioned this book many times. He's a founder of a PayPal company, and he said that he was talking about artificial intelligence, and he said that artificial intelligence approach is a big data approach. But he said this big data, in the case of artificial intelligence technology, he called it a dark data because the world is a changing environment. There are a lot of changing environments, and I think that, of course, I'm sure that market people behavior it's also a changing environment. We have a basic structure, and we, as a trend followers, we use this basic structure, and it is unchanged, and can because of this adaptiveness, and because yes, it's unchanged and adaptive because we have trends, outliers, and we always will see this capture with our techniques. But some things are tangible. So artificial intelligence, in this case, really, it's a very huge amount of data. Cannot predict, for example, 50 years of data of orange juice could not predict that it would be such a big trend in this market. On one example here. So, again, very happy to be here to see all of you, and let's get started. And our discussions are always very interesting. Our trend following is a very deep topic, and maybe we often talk about the same things, but it's always very interesting to talk about this. For example, thinking about diversification, the same thing, but it's a very interesting topic that even very, and we have talked about this, that even very highly correlated markets gave, if you, for example, trade crude oil and Brent oil, even if they have the same move, it can be different results. Different results because maybe you are stopped, maybe a few pips lower or higher or something like that, and the result will be different, even with 9% correlation. Oh, very powerful tool. Diversification, very powerful tool. And risk management is very powerful too. So let's get started. Again, I'm very happy.
Thank you, Oleg. One thing I forgot to say is that when I was in Versailles I had a friend, we had one of our Spaces friends come to visit me at Versailles, and so we had a good chat. One of the guys that shows up here almost every week came down from Romania, and we had never met, you know. So my wife was like, "Who is this guy? Who are we meeting?" I'm like, "I don't know. He seems like a nice guy on Spaces." So we had a nice chat, nice lunch, and then he sort of told me that he was trying to get Oleg to come to Versailles and to hang out. And I was like, "Wow, what a shock that would have been if they would have surprised me with Oleg coming as well. I mean, that would have just been so much fun. One of these days, we're going to hang out, Oleg. I don't know where it's going to be, New York, Moscow, somewhere. We'll hang out one of these days, and we'll get to see each other, meet each other. I think he ended up sending a picture of us to Oleg, but that would have been really shocking if you would have shown up there as well. Anyways, hello, Richard. How are you?
G'day, Jerry. G'day, Oleg. G'day, everyone. Yes, that would be great to bump into Oleg. I'd love to do that. But yeah, that orange juice, that's a very sweet trade. Yeah, I agree with your comments, Oleg. And but Jerry, I'm so glad you're back. I was sort of suffering from withdrawal symptoms. The Jerry withdrawal symptoms was affecting me, and I was starting to shake. And I'm so glad you're back. You're back at the helm. Good to see. Hope you had a great holiday. But yes, look, um, the Mike Harris tweet, of course, caught my eye, and I did a bit of research today just to make sure I wasn't dreaming when I did my prior research on this topic, where we've continually insisted about how diversification improves our compounded annual growth rate and our returns in general. We don't see this sort of deterioration in diversification benefit as we increase our number of markets. And I did a short and nasty test, even though it took me the whole day to do it, which clearly demonstrates that, I was getting up to, from 10 to 20 to 30 to 40 to 50 markets. Every lift that I was doing, I was getting a progressive amplification of my CAGR for every portfolio I ran, selecting random portfolios from the universe of 55 portfolios that I was assessing. And in every instance, I was finding that we got this improvement in CAGR with equivalent drawdowns. So I was sort of risk weighting it to the equivalent drawdown for every scenario, just to ensure we're dealing with apples for apples. And yeah, I certainly wasn't seeing any evidence for deterioration in diversification benefits. So I don't know from what angle Mike was coming from. I have a feeling there are a number of assumptions in there. It's certainly not valid in accordance with how I trade my trend following models. So I'd be interested if this, the further discussion was had tonight about it. Maybe there's something I'm missing, but I don't think so. But great to have you back, Jerry.
Yeah, it's great to be back, and thanks again. I know everyone you had a lot of people listening in, and I know it was really worthwhile. Yeah, I mean, JoJo. I don't know JoJo, but I started following him. He had some good comebacks.
He's on Spaces occasionally. I saw JoJo's comments, and I was giving a big thumbs up for JoJo.
Yeah, me too. I like JoJo, so hopefully he'll show up and participate, and we can. But he is having some good comebacks. One of his comebacks was, well, there was this thing that Harris was saying about he agrees with the replicators who trade 10 markets or 26 markets for trend following. Trend following is about market timing. Increasing the number of markets defies its very purpose and turns it into a wealth preservation scheme. That I don't understand. I mean, there's nothing there to argue with. It's a statement with nothing there. I agree with Andrew and Gestalt you with using 10 or 26 liquid markets for trend following, where Jojo made a good point. He was the first one. I mean, it's a good point, and that is it's replication. It's not for trend following. It's for replication. So there is no agreeing with those guys as far as all the managed futures people should trade the same 10 or 26 markets. I asked Andrew, I listened to Andrew's podcast with, on Corey's podcast. It was Adam Butler and Corey Hofstein and Andrew, and I got a little confused. So I asked Andrew, like every day I look at the DBMF positions, and it is every day. I look at them, and it's 100% 14 markets with positions on every day. So evidently, the algorithm has 14 markets, and they have a position every day. There's no flat. It's long or short in every 14. Yet he kept saying something like 10 factors. There's 10 factors. And I kept thinking, what do they mean by 10 factors? And so I asked Andrew that, and he said offline, he said, well, it's 10, I don't know. It was something like there's 10 markets we look at, but we express them in 14 markets. So there's 10 things we look at, but we have to trade 10 years, ultra 10 years and the regular 10 years for regulatory purposes, which I didn't really understand that. But okay, so if you were listening and you got confused like I did, but that's a really good podcast with them talking about the two different ways of replication and the whole replication thing. ETF thing is pretty good. Oh my God, come on, Adam, got to call you out, buddy. I think it was on Adam's podcast. Can you imagine having Jerry Parker on a podcast for an hour and a half, right? Recently. And, come on, one amazingly good one yesterday as well. That I say the same thing over and over. I can't shut up about the same topics, right? Trend following plus nothing, 300 markets, stocks. And so in this podcast, Adam is like quoted as saying, I can't remember, but does Jerry trade single stocks? Man, oh man, I got to up my game. I got to even be more intense, I guess. So anyways, yeah, so this is Harris again. It's mind-boggling. There are people in trend following who think trading many markets will increase their total return. I was surprised listening to their misconceptions, and I wrote this article. I'll tell you right now, I have never said that, never, that we're going to make more money by trading more markets. I do think that you will have less bad luck, and you will have a smoother return, and have the outliers will be more evenly distributed, and that will have a positive impact on the compounding, right? Humble, minor parts, but if with a fixed, we've gone through this many times and explained it many times. With a fixed universe, a risk budget divided by the number of markets, you're trading. Whenever you start adding a lot of markets, you trade each market smaller. So I get with 300 markets, I'm going to get 30 outliers per year. With 30 markets, they're going to get 3. And you can see right then and there, I'm going to have less bad luck than somebody who may get 0 one year trading 30 markets, but 6 the next year. So, yeah, we've never said that. Now, I will say, and no one ever comments on this ever, I keep track of my brilliant statements that people ignore. And the tweets, my God, some of those tweets with no likes, unbelievable. And that is that when you do trade more markets and you get more diversification, 300 markets, you can up your risk budget a bit, I would say. So if you're trading like 4 units or 5 units divided by 300 markets, maybe you can up that max units risk budget a bit because of the increased number of markets. So to that degree, with the improvement in the compounding, the improvement in spreading out the outliers, and the ability to trade a little bit larger risk budget, the more markets you trade, concrete reasons there that statement is incorrect. But I'm willing to let it slide because I've never really promoted that idea at all. So that's made up. Also, the use of the term outlier has led to misconceptions. Well, and here comes some misconceptions, right? Trend following does not know whether a signal will result in a large gain. There is higher probability it will be a losing trade. The outliers are only known in hindsight. Yeah, and JoJo was like, yeah, duh. Who has ever said anything other than that? Trying to catch many of them impacts total return adversely. Yeah, no evidence. Not sure how that's possible.
I want to say that when we diversify across a lot of markets. It's not the only benefit that we can capture the more outliers, but of course it's one of them. It's maybe one of them. Maybe it's the most beneficial thing, but also smoother our returns. Our drawdown can be less, and some different good things with this. So a lot of benefits. Of course. It's less risk because hidden risks are less. Also, for example, gap risk. And we were talking about it's not only my thought. I remember that maybe Moritz said that the gap risk is less, or maybe the risk of a gap if you have a lot of independent small bets, and on the one market you have a big gap, it's a less problematic situation than you have a big gap on one market. So this concentrated risk budget, it's not the best thing. The best thing is to diversify and to have a lot of small bets as much as possible. So I like this very much. I like this.
I remember I was watching a film of the big wave surf riders, not the normal surf riders, but the ones that hunt the big waves. And because they're after these unique anomalies that they, are very few and far between, the way they do it is they fly around the world. They basically hire a charter plane and go around the world searching for the big waves. And that way, by diversifying globally across the world, they might be able to get 5 great waves a year. And it's so similar to how we're hunting these outliers. Through maximum diversification, we are globally diversifying, maximizing our chances to participate in these anomalous events. I really can't see the angle that Mike's portraying here.
Hi guys, how are you? Can I ask you something about the operational differences of going to hunt many outliers? I mean, if you go from 40, which is the old school number of contracts, to 100, 200, is it very, burdensome or very complex to do an operation for so many contracts? And is it an operational risk?
Well, I definitely think it's, can be an operational risk. Um, you have to have your act together and your technology and your people. It's a huge hassle. Golly, can you imagine 320, 30, 40 markets we trade now in an ETF, and you may have to be ready to make adjustments for capital inflows daily. Yeah, so it's a bunch of crap, and you're making 100 basis points. So it's kind of it's a big, huge issue. Although, um, as with everything, you're not always going to be perfect with your execution and with the admin and stuff. And so, um, every mistake, the small bet size has benefits in that regard as well. Oh, we forgot to do this trade. Not that we've ever done that, or we didn't handle this trade correctly, or we got a bad fill, or whatever. And okay, so it's 1 out of 300 plus markets. So yeah, so that those numbers kind of work for you too. It's infinitesimal. I mean, like I was trying to tell people yesterday. Oh, someone on this podcast last night. It's a really good one. It's going to hit pretty soon, but I was being grilled by like 10 people, and it was really fun. Um, but they were looking at my positions going, are these even real? They're so small. How do you have such small positions? What are you doing? Are you just playing around? And I'm like, no, they're all legit. It's just the size it's the AUM and the fund, and it's 300 and some markets, and we're trading really small. And when we take a full loss, and I'll bet you my stop loss is bigger than most everyone else's. The number of ATRs I give the trade is out a little bit beyond what people would think would be optimal, and would disagree. And I have no problem with that. But yeah, it's and so then, but I still only lose 12 basis points. If I take a full loss, which I frequently do, and so that's the small bet size has ramifications throughout the positive ramifications throughout your whole business model. Crap, I'm trying to find that one quote from Harris where he says something about the Sharpe ratio. And he basically said, it was a little contradictory. I got to find it, but until I find it, I'll paraphrase it. It was something like, these outlier hunters, they don't care about Sharpe ratio, but that's what gets improved. The Sharpe ratio of trading, your Sharpe ratio gets improved with classic trend following if you trade 300 markets or whatever, more and more markets. And Jerry talked, he doesn't say my name, but Jerry talks so bad about, makes fun of this Sharpe ratio. Usually his complaint was not to address the issues scientifically or mathematically. It was to say clients like it, so shut up. Okay, I get that. I'm not going to shut up though. So, but he says now you're making fun of this Sharpe ratio. You don't like it. It's bad, but that's all you're accomplishing by trading these 300 markets. And once again, I mean, I kind of blame myself maybe because I guess I haven't been that clear. I need to be more clear. And that is that I implicitly in my criticism of the Sharpe ratio is the idea that if you try to maximize it in any other way than adding markets, you have to make these suboptimal, less robust compromises. In order to have a better Sharpe in trading 100 or 50 markets, you've got to have, I'm going to seek out maximum pain and suffering and volatility for no good reason. No, the good reason is robustness, and adding these markets is the correct way of improving your acquiring some smoothness and trading multiple systems, multiple entries and exits in different, all classic, all one entry, one exit, and a stop loss. But that's another way of properly improving the return characteristics of trend following. But anyways, I guess I wasn't clear enough. But that's pretty, I think, easy to understand. But he was contradictory on that too. I got to find this quote because at one point he said the returns were worse, but then he said the Sharpe ratio was higher. But yeah, it's just kind of fun. I wish he was more amenable to a back and forth grown-up discussion. I'll keep going with that. I don't think I'm following.
Hey guys, hi everybody. Jerry, welcome back. Welcome back from Europe. So I'm assuming it was just France, no other places in Europe. So it must have been fun. So yeah,
Yeah, it was very fun, and we did just France. Yeah, so last year we went to London as part of this trip, and I got a chance to see Alp, and I missed seeing Alp this time, but I definitely want to.
yeah.
Oh, I'm going to see Alp soon, I think. So we're going to hang out soon, so that'll be fun. But yeah, it was a good trip, and France is fun, very nice. My wife speaks a little bit of French. She was really good. She was getting lots of compliments, so that helps
That's
quite a bit.
nice.
Yeah.
I'm still in Europe, by the way. I mean, this is my longest stay. I've been in Europe for like months and months now, and I like it. So yeah, you mentioned you met somebody somewhere, but so it would have been fun to kind of run into each other or even organize something.
About something. I don't know if it's a good theme for the podcast for the space, but about cash strategies and cash optimization strategies. Like you are doing futures and not equities or contract for differences, and you have to get your necessary cash to run the operation. And do you do you try to put 100%? And given that the interest rate now is quite high, are you all the time trying to put 100% of your funds in treasuries or something like that, or do you need to put some cash aside for daily P&L, or is there a way to use that P&L in a way that you can still earn some money on it, or is it something that you have to leave aside?
Yeah, so we take this cash management pretty seriously, and we attack it from a couple different ways. One is Cash Manager, on the futures side who daily keeps track of the margin requirements and moves money in and out of the FCM accounts, the futures accounts, and the foreign currency forward account. And so they are maximizing that interest income daily. And then on the stock side at IB, we trade a lot of stocks and we trade a lot of shorts. Oh, one thing was kind of funny yesterday was I live in this futures world and I kind of force people in CTA trend following world, and I don't really try not to, I don't try to get along too much. And I just sort of I wasn't thinking when this guy he was like asking me these questions about my stocks. And he's like, you have no exposure to stocks. You have almost no exposure. It's 50% of the portfolio, but you have like no exposure. And I'm like, what? I have tremendous exposure. And then what he was talking about was net exposure. I'm like, no, I'm long a ton and I'm short a ton. I'm mostly long, but just, not too much more long than short. And they're all trend-based trades. And so, okay, so that's one thing I wasn't really thinking of. I look at those as sort of it is somewhat of a hedge, but it's not, there are days and times where my shorts go up and my longs go down on the same day. So, and then he said, he was saying, no, you're mostly short. And I'm like, no, I'm not mostly short. I'm mostly long. And then after the podcast, I was thinking, oh crap, he was probably looking at it from a notional point of view. And I look at it from a VAR point of view, that from a notional point of view, I might be mostly short, but from a ATR point of view, I'm mostly long. And so it's kind of funny. But yeah, so on the IB side, we're moving, we're doing a lot of trading, we're shorting. And so the cash is fluctuating daily. And we do keep a tiny cushion so we don't have to do a cash management trade every day, but we avail ourselves of these treasury bill ETFs, and they tend to be fairly competitive. The treasury bill ETFs, so we're moving money in and out, and there is no settlement period. There is no 2-day settlement for the treasury bill ETF, as long as the money is not moved outside of IB. So, and then we also utilize some of the short-term treasury mutual funds as well for diversification. So it's pretty easy and transparent. There is the cash management firms have difficulty navigating inside of the IB account, unlike the FCM accounts. That's my summary, and I don't really know too much more than that. Like, can we set up the cash manager to go inside of our IB account and do what he wants to do and move money around? No, we can't do that. So IB is very awesome as it relates to the cost and leverage and portfolio margining and commissions, but there are some downsides to their risk controls. They're super duper interested more than almost anyone about their safety and risk control of crazy rogue traders. Does that answer your question? Hello, Moritz. How are you?
Doing well, although I got a little bit of a cold, but that's only going to make me stronger, I guess. So, no, doing well. Good to be back. There's really three things
I think it's just
like in my head. Oh, am I?
No, you're not. Cordura is having technology problems.
Oh,
yeah.
Okay.
But you're fine. You're fine, Moritz. Go ahead.
All right. So three things on my mind pretty much all the time. I mean, we touched on many of them, but obviously dynamic position sizing. Let's keep that aside for today. But this is the one thing that I'm no longer willing to move an inch or a fraction of an inch on. it doesn't help, and it is a fight that I will probably fight until it's decided. The other thing is on replication, that you can create these clusters and have 10 factors or 10 markets, and essentially achieve a good trend following portfolio. I disagree with that as well. I think it is in somewhat in one way or another a riskier approach. It is less diversified and it's more prone to gap risks and negative surprises, negative outlier moves, especially because you don't have a risk budget on a market. You may stick with a losing trade for far too long and not be able to avoid disaster. But the thing that I want to bring up today is really this idea of or people not agreeing with us that adding more markets, and forget about correlation, if they're not all perfectly correlated, that's somewhat less than one, right? Adding more markets will always help. I mean, this is a cornerstone of what it is that we do. I find it difficult to even fathom that, like, be that Mike Harris or other people. I mean, they have a background in our field. They should understand this, and yet they go out of their way to essentially argue the opposite. And it just, I didn't even respond to that tweet because I scratched my head like, there's nothing that I can say. I mean, this is kind of ludicrous. It's weird, really. So adding markets helps a lot. And what I just want to bring up, give me another minute, but I thought, so Jerry and I, we were DMing yesterday, and I think he had a very brilliant thought that I thought about more in the evening here. And this is, imagine for a second that we're trading 1,000,000 markets, not 300, 1,000,000 markets. And let's also assume that they are, somewhat uncorrelated, so they're not all the same. What will that do? I mean, essentially what that will do, it'll make us execute tons of trades, like many, 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 many trades every single day. So this means that we're going to be moving our return into a different space. Think about the like a casino analogy, if you want. We already own the casino in the way that we trade. We're not the ones, not Jerry, not Richard, not Oleg, not me, none of the people here on the podcast, I presume. We're not the ones going to the slot machines, putting in the money, and playing on negative odds. We have backtested and developed systems. We know what we know what the historical trade statistics are. We don't know what the future ones are going to be, but we have sample size and reason to believe that what we're doing is solid and that we haven't curve fitted. And therefore, there are, the odds that we play, they are in our favor because we keep losses small and we let the winners take care of themselves. They're unlike a roulette wheel where, let's just for argument's sake say it's 41-51. Our casino is much more skewed because we have these massive positive outliers and we have many more losing trades. So it takes us a lot of spins of that roulette wheel to have the odds play out in our favor. And essentially the probability of a single spin, it could be a losing trade, can be winning trade, small winning trade, large winning trade, but we have to spin the wheel a lot of times. And only if we do that can we, see the stats play out. And now when we increase the number of markets and we're trading each of these markets small, that just increases our spin rate. We're going to be spinning that roulette wheel, let's say 1,000 times a day or 2,000 times a day. But we spun it 2,000 times in our lives. Maybe, Jerry, 3,000 or 4,000 times, I don't know, depending on the system. But you get my drift, right? We're essentially moving from our entire life as trend followers over a 40-year track record. In the case of Jerry, we're moving this into the equivalent of a 4,000-year track record because we're increasing our participation, our operating of the roulette wheel, our casino ownership. We're magnifying this every day. We're playing so many times that really the end result must be that we're not guaranteed to make money every day, but we'll get very close if those statistics hold true. There's it just moves we essentially become short-term traders intraday with our long-term systems because we're spinning the wheel so many times. Like, I just love that idea, and this just goes to show this: the more markets we trade, the more independent stuff that we can put into our portfolio, the better it is going to be. I mean, you can. I just framed this from a different perspective and gave this a different narrative. You can go market vids and do all the equations, yada yada, right? And maybe you believe in them or you don't. But this is a bedrock thing to me that is so crystal clear to me, not apparently not to others, that adding markets and going out there to find things which which zig when other things slightly zag in your portfolio. This must be, it is positive, and there's just no argument about this. So thanks for listening.
Hey guys, yeah. So I think I have an explanation of where Mike Harris is coming from, although I don't see his tweets, and I think he has blocked me probably. I mean, he blocked me before, and he unblocked me. Now I'm blocked again. I have no idea why. So I must be blocked by him. So I don't see his these discussions that you guys are talking about. I only hear about them from you. But what where this thing statement is coming from, that he's saying that trading many markets, you're basically preserving your wealth and you're not shooting for returns, but you're just kind of trying to quiet things down and not shooting for outliers or whatever. By the way, I agree it's wrong. And of course, we've spoken about this hundreds of times here, that the more markets you trade, the better. And the best number of markets is the maximum that you can trade, given your liquidity and access to markets and size of the planet. And so the way I understand it and where they're coming from is coming from long only equities, where the first hedge funds, when they started in the 60s, in the 70s, and even now, like if you're like a long only hedge fund who's picking stocks, like basically stock pickers versus big asset managers and the Vanguard and the S&P 500. So everybody's trying to be the S&P 500. And if a stock picker wants to beat the S&P 500 by a lot, he better have only few bets. So the less, be very selective into which stocks they invest, they put their money. So the very selective stock pickers will have 3, 4, or 10 or 12 stocks that they hope, because they analyze them, they search them, they have their value, their growth, they know the CEO, they have some kind of an edge. So basically the theory in the long only equity hedge funds is that alpha comes from selection. So the more selection you have, i.e. the more selective you are with your picks in your portfolio, the more alpha you add. The less selective you are in picking, so let's say S&P is 500 and your benchmark is 500, you want to beat S&P 500. If your portfolio is 300 stocks, then you're less likely to beat S&P 500 by a lot. And it's much more likely to beat S&P 500 by a lot if you only have 3 or 10 stocks versus a portfolio of 300 stocks. So their argument is, and which is a valid argument, but it has nothing to do with what we're doing. And I would expect a systematic or a quant expert like Mike Harris to know the difference. He's comparing apples to oranges. One thing doesn't make any connection with the other. So basically, in their world, in the long only active management funds, hedge funds that have a portfolio of 3 to 20 stocks are more likely to beat the S&P 500 on a particular given year, or over a 10-year period or 20-year period. If they're good selectors, they're going to really kick the ball out of the park. If they really select their 10 or 20 stocks really well, they can beat S&P 500 by a lot. Whereas somebody who constantly has 300 stocks out of the 500, he's not going to beat S&P 500 by a lot. And the more you approach 500, the more your returns going to look like S&P 500. Therefore, you are kind of shooting for wealth preservation. You're not taking risk. You're diversifying away your alpha, and your alpha now slowly gets dissolved into beta. And therefore, you should be charging less because you're less selective. Your alpha is now mostly beta, so you're now S&P 500. You should be charging like what Vanguard 500 is charging. Vanguard S&P 500 fund is charging. And to translate this world into what we're doing and saying, oh, yeah, you guys trade everything out there. You trade 300 markets like Jerry. He's just dissolving his alpha. No, because his alpha is not in the selection of the markets. Jerry doesn't claim, nor I do claim, that my alpha comes from market selection. Even furthermore, we specifically claim that we do not select markets. We don't want to select markets. We trade everything in the kitchen sink. Just, is there a market? Give it to me. So our alpha does not come from selection of markets. Our alpha comes from other things, and which is obvious where it's coming from, which is completely different from where the alpha in the stock picker hedge funds are coming. So I'm just to explain to you guys, because to us it's unreasonable. How can somebody claim these things even though we're proving to them that they're wrong, and they keep claiming them? I think because there's a misunderstanding here, and that side needs. So now our side, hopefully, after I explain it, understands where they're coming from and where their error is and their mistake is, and I hope they also learn this, and then they stop making stupid statements like that.
That's brilliant. That's really good. That's perfect. Yeah, it's just coming. He doesn't look at it from a mathematical betting point of view, where every time you bet, you have an edge, or you don't bet, and it's more like you were saying, this discretionary or value or non-math systematic approach. And it's such a joke. I get kind of embarrassed, like explaining to people, like, oh, my universe is a fixed universe. Not only am I not out there trying to find good stocks, I'm trading the same ones all the time if all goes according to plan. I don't like it when one of my stocks gets bought out and goes away, which has happened like 4 or 5 or 6 times this year. So yeah, it's really a whole different ballgame. But on the other hand, on the next tweet, he will post some of his trend following, one entry, one exit, stop loss research, and so show how good it is. So I'm not really sure how much confusion there really is out there. One of the things too that Tommy, I don't know Tommy, but Tommy was posting some funny tweets, critical tweets.
Yeah, I saw that as well, Jerry. Yeah.
Yeah. But I like Tommy's tweets because he reverses. He reverses a bit. Okay, so he goes, I haven't seen the outlier theory play out in practice yet. Or as Niels from TTU would say, it doesn't show up in the numbers. So just show us these mythical outliers, Jerry.
Yes, it's the mythical outliers. I love that. And I've just posted up the orange juice trade, for God's sake.
Yeah. Can you show, do you have time to look at 40 years worth of trades? And this is the same point I keep making to Niels and to anybody who will listen, about this. Haven't seen it in practice yet, which Niels never admits to doing a ton of in-depth research. So, and that is that Richard, Moritz, Jerry, Melasinos, and Mulvaney are the only traders I know that are trading for clients. Apologies to everyone else, that doesn't cut profit short. And so, yeah, there is no numbers out there to really see about mythical outliers because they get rid of the outliers if they get too volatile. They cut them back and get out of them and try to normalize them back to the other markets in the portfolio that are not having the outliers. how in the world else can Andrew replicate 20 CTAs that trade hundreds of markets by only trading the euro and the yen? Because when the yen gets going, like it did last year, and has a tremendous downtrend, they scale it back. So it starts to look more like the pound and the Swiss and all the other currencies that are not having these outstanding outliers. And they're so large, they don't even trade orange
What
juice.
makes me laugh, Jerry, is that, Mulvaney, you, all of us, we put up our trade distribution results in a histogram where we show that, 5 to 10% of our trades are outliers, something like, up to 100R or 180R or whatever. It's clear that they are outliers. And then Tommy says, where are these mythical outliers? I mean, they're in our trade distribution, for God's sake.
Okay, so anyways, Tommy goes on and he goes, of course, from a risk management point of view, I think Jerry's 300 markets are superior to any less diversified trend approach. Okay, so all of a sudden you see we're on one hand, we don't pay attention to Sharp. We let profits run. We're not, you need to pay attention to total total AUM. You shouldn't split up and we're accused of like, you shouldn't, why, it's dumb. Why are you splitting up closed trade equity and open trade equity? You can't just have this volatile performance and ignore the open trade volatility. Clients don't like that. Okay, now Tommy says, well, from a risk management point of view, Jerry is superior for trading the 300 less diversified trend approach to any less diversified trend approach. All right, okay, yeah, you're right. I'm trying to say that. But then the next sentence is really a good one. This is something that people should have said about me before he did. I really like this because it sounds true, but it's not. There's not much here. Although I'd say 150 single stocks cannot count as 150 markets due to strong correlation within equity sectors. Good point. Certainly something I thought about more than anybody else since I'm stepping on, since I'm getting ready to do that, right? I'm like, Jerry, what are you doing? I'm talking to myself. Right. So I think that it gets back to this point Moritz was making that they're not, foreign court trades 500 markets. I trade 300. None of these markets are all like really sufficiently uncorrelated to the amount that we wish that they were. We wish they were really, really uncorrelated. So how many markets are really out there? So the analysis that traditional people run is once you get past 30 or 40, then the benefits of diversification start to go away. True, as long as you're not hunting outliers, because we are the most diversified managers on the planet with the 300 markets or the 500 markets. But me personally, I don't care as much about diversification as other people. Like, how is that possible? How can you be so hell-bent on trading so many markets, and yet you say that you're not that concerned with diversification like other traders? Well, because I appreciate that diversification I get, but you understand I do trade crude and Brent. So that's a big a lot of evidence that I'm not really taking this diversification that seriously. Choose one or the other. And I trade heating oil and unleaded that are like 90% correlated, the same size as the crude and the Brent. So it doesn't seem like you're very serious, Jerry, about this. Well, I am kind of serious, and I do trade lots of different markets, but I basically trade those markets for the potential outlier possibility that heating oil can double and crude kind of sits there. And that has happened a few times in my career, and I made a ton of money off heating oil, and not so much at that time in crude. And the same thing happened with silver and gold. Silver had a huge trend in '87, and gold kind of sat there. So to that degree, since we're primarily hunting the outliers and realizing that even though markets are highly correlated, they can have much different performance. We had a great 2021. I think due to trading all of the grain markets, and corn and bean and wheat all had good trends, but oil and rapeseed and canola had much bigger trends, even though they were all highly correlated. So, and then it's not fair to single out single stocks as being having strong correlations, which they do. Because look, I have no diversification in my interest rate position now. I'm short like every interest rate futures market in the planet, and they're all short. And we've been short for so long. And at one point, we were all long dollar. There was no really not much except the peso, maybe Mexican peso, which we were long that versus the dollar at some point last year. But frequently, we get in these situations where we have lots of diversifications in a sector, and I'm sure and it doesn't, and we're just totally one way. And so it's not just the stocks. And I'm sure there's been times, and there will be in the future, where all the commodities are going up or all the commodities are going down. So if you want to take that, you want to think about that and take it into consideration in some way, that this is definitely possible. I mean, there's times where all the longs are doing the same thing and all the shorts are doing the same thing. And there's times in COVID where we were long almost every market and they all went down. So longs are correlated, shorts are correlated as well over the sectors. And
I think
then
a lot of these people, Jerry, making these statements, like they're making it from the position of they're trading 20, 30 markets. They're concerned about Jerry Parker because he's trading both Brent and crude, and yet what they don't realise is that they've got 1/30th of the exposure effectively in their position size to those markets. You've got 1/300th to each of them. Totally different kettle of fish. You've got 2/300ths when you have your Brent and crude, compared to their 2/30ths. So yeah, I just don't think they appreciate where we're coming from.
yeah, true. But I like to use these random questions with a grain of truth, just a grain of truth in there. That I run out of material, and so I'm happy to get these kind of things that seem true, but they're not. They need to be fleshed out more. So it's just an opportunity to. And so we'll have to go over this. This is a limited subject. Part of our reason for existing is we don't add a lot of bells and whistles, and so we run out of things to add and do, except adding more markets and talking theoretically about how this works. And so I don't mind, dealing with these issues. But oh yeah, and then number two, I would say is just think about my portfolio of stocks, and now I'm long a lot, I'm short a lot, I'm flat a lot. So if we were to get a shock in the market, it would be much better. And then all the stocks would go down. Yeah, 100%. But that doesn't take into consideration, well, what's your positioning? Were you all short, mostly short? Or were you, like you are now, long a lot, short a lot? And then overlay the trend following on top of that. So I think a lot of people learn about stocks from this buy and hold point of view, like I did, watch Wall Street Week, hear the Wall Street way of thinking about things, and you introduce trend following, and it just takes a while for them to get the idea, understand how trend following is going to impact and negate some of the things they thought were true when it comes to trading stocks. So if we have a big rally in interest rates, I'm going to get stung. If we have a big rally or a big sell-off in stocks, not as much, probably. So because it depends upon how your positions, trend following goes with the trend, and you can overlay the trend on these markets and have some shorts, have some longs, have some flats, or be 100% long or be 100% short, anything in between. And so it's just no way to make a blanket statement that says you can't count these 150 markets. If you scroll through, download the spreadsheet, put these symbols of my stocks in bar chart into a watch list, bring up a flip chart and start scrolling through the stocks, and you'll see they don't look like the S&P. A couple of them might, but some are in big uptrends, some are flat, some are in big downtrends, some have had big trends and given it all back. Some have had big trends, given it all back, and gone back to the highs again. You can even tell what you're looking at. If you covered up the name of the market, you wouldn't even be able to guess if it's a stock or a commodity. So you've got to put work in. You can't trade the 7 biggest stocks and be done with it, or trade all NASDAQ or anything. You've got to go out there and do the work and find the stocks that are that coal companies and uranium companies, plastics and mining and food companies, and build up a portfolio. It takes work. The managed futures CTAs, they download whatever the CME gives them, whatever's traded in Europe, and that's what they trade, and they're done. I spent a lot of time and energy continuing and have over the years creating this portfolio to try to maximize the diversification. But I'll tell you, on days when the Dow's down a lot, I lose on almost all my stocks. And then when the Dow's up a lot, I make money on all my longs. And then when it's mixed and not so extreme, they go back to doing their own thing, and the charts they don't look like the S&P. They look like they're different. So it's a complicated, but not that complicated situation where, yeah, you can't, if you don't want to count the 150 single stocks as 150 markets, then don't count the 50 interest rates as 50 different markets. But, it's the best we can do. It's what we have, and it's better than not trading 300 markets and not trading the 150 stocks. That's the litmus test. Is it better than, not is it perfect? What do you think?
Here.
Hey, Jerry. It's Adam here. Happy Friday, everybody. I hope everybody is doing well in trend following this week. It's been a little bit volatile, so I hope everybody is managing or has come into the week with the right position sizing, because if you haven't, it would have been a tough one. So I agree with everything that's been said in terms of more markets and specifically, big mistake just doing trend following on stocks only, or one particular asset class, or even one instrument, because I think that defeats the whole purpose of a multi-asset trend following in the way that Jerry espouses. So I'm in full agreement there, but one question I do have, to Jerry or to anybody else, is what is that risk budget for the equities slice, and Jerry in particular, does having the 300 stocks, does that allow you to radically increase that equity slice, or are you still sort of constrained by the relationship of equities to the other asset classes? Thank you.
Yeah, well, I think one of the most important things you can do is you need to, on day one, when you're coming up with your system and your systematic approach, the most critical first question is, what's your overall risk budget? 4 units, 5 units, 6 units. And it's going to determine, your typical days and your worst days. And then you have to figure out how much you're going to put into each market. I put an equal amount into each market, but you do have to sort of look at, if you're going to trade single stocks, you're going to have to make an implicit call on the weighting of those stocks. You don't have to do that if you trade futures only, because there's like 30, 25, 30, whatever, 35 indices. There's 55 commodities, 56 commodities that I can trade. There's more if you go to China. There is 30, 40 interest rates. There is 50 some currencies. And so then there's 1,000 stocks. So you can't trade all the stocks. You can trade all the indices and all the commodities and interest rates and FX, and you have sort of a balanced portfolio without even doing anything. And so you're set. You don't have to have this anxiety level on how much stocks to trade. So you need to figure out, even with all the benefits of the trend following overlay and going in there and creating a portfolio of diverse companies and commodity related companies, and seeing in real time in your back test that, oh yeah, I do have some longs and shorts almost all the time. I'm not too overweighted. You have to still be concerned about, I was 100% long all my stocks once, and I forgot the year, but I made a ton of money in that year. But then the next year was the big drawdown. I can't think if it was 13, 14 or something like that. I can't remember the year, but It was like one of the greatest years of all time for big cap stocks, and that's what I was trading at the time. And the stock only fund made 60%. And in kind of a subpar year for CTAs, I think we made like 30. We were totally outperforming. But then the next year we got crushed. So you have to take into consideration things you've never seen before. And if you're going to get out there and trade a lot of stocks or overweight a certain sector, you know, or get involved in these sectors and frequently see that you're going to be all long or all short, like we are all short in the interest rates now, then, just got to be aware of all that and have that impact your total risk budget. Now, I said on this podcast that I did yesterday, the stocks are 50% only for one reason, and that is because they deserve it. Because being able to choose between thousands of stocks and come up with 150 stocks that are to try to achieve a portfolio of stocks that are has good diversification characteristics, then I can do that if I can swim in an ocean of 1,000 to choose from, or even 2,000 or 3,000 stocks to choose from. I can't really do that if there's 55 commodities total. Okay, they don't deserve more than about 25% of the portfolio. Stocks deserve way more. Is 50% right? I don't know. Is it magical? Should it be 75? Should it still be 25, given that the correlations can get really high in the stocks? Well, I don't know. It's a judgment call. It's a back testing call. But they only theoretically deserve their weighting. No sector deserves to be weighted any more than the amount of diversification that sector gives you. And I think that stocks, as evidenced now, can have periods where there is the most amount of diversification if you're doing longs and shorts, and if you have a trend following overlay, and if you've gone in and done the work and tried to put together some of, like we have, a really crazy diverse portfolio. I've encouraged people to scan down through that portfolio, and it just makes me giggle and laugh about some of the stupid companies I have in there and the amount of diversification. If you look at it through that lens, when you scan and scroll down, you'll see that on a certain day or week or month, they're all going to go up or they're all going to go down. But then they're going to I am not a very good competitor to, I've said this before, but I'm not a great competitor to Standpoint and Abbey and Milburn products that have hard coded into their funds 50% managed futures and 50% long only stock indices, because those guys are getting the S&P return along with the managed futures. And that's a good product that people like to buy because they get the stock 100% long only stock exposure, the return stacking from Corey. They are getting that S&P. I don't get the S&P returns. Sometimes my stocks on average dramatically underperform the S&P. I sort them based upon the profit each day. And sometimes the S&P is like at the top. It beats 150 stocks of mine. And then sometimes it's at the bottom. And that's what true diversification, that's what it looks like when you try to commoditize the stocks. You try to take the stocks and make them look like the commodity sector. You don't get stock S&P return. And so I'm not really good at beating those guys when stocks do really well. I am maximizing what trend following can do, irrespective of, and not trying to target managed futures plus what people consider to be the market, the S&P.
Yeah, that's really interesting because I think that, and I'm assuming that your correlation to equities, is low, and I think that's the whole point. I think of what we should all be doing. This group and this industry is basically working on, a low correlation. To other assets, and if you're doing the stacking with a passive index plus trend, you're still getting half of the portfolio in a positive, a 1-to-1 correlation with the S&P 500 or whatever you blend it with. So from our perspective, we're doing less equities, than yourself. Significantly less than 50%. But the idea is we're still sort of looking for that low correlation with the traditional equity market, because that's the whole point, right?
No, that's not the whole point. Not at all. Not from my point of view at all. I am not. I think I heard you correct. I'm filling out this birthday card because I've got to pay attention to her birthday. But I'm going to win.
Saying that we don't want to be over the long run, correlated with these traditional asset markets. So when you blend in the different asset markets, the currencies, the commodities, the equities, and the bonds, the idea is that over time, effectively, the correlations with any particular broad asset market is low over the long run. And that's why people should be interested in trend following, because of that lower correlation to the traditional S&P 500 index.
Right. I mean, that's just a little bit too close for me to Crisis Alpha and the traditional way the CTAs are used. So I'm going to be the one person who says, no, that's not correct. My goal is the perfect portfolio. No one should need or want or add anything to the maximally diversified trend following only portfolio. I don't want to be long stocks all the time in any amount. I don't respect intellectually or practically an 8% average return and a 50+% drawdown. I don't want that crap near me. I don't want it touching me. I don't want it in my portfolio when I know better. If I didn't know better, sure. And I'm not saying I hope a lot of people buy my funds and do exactly that and use me for Crisis Alpha. I personally can't sanction it. I personally can't accept it. I'm not going to lie to them and water down my approach, water down my rhetoric, water down my knowledge, and make them and agree with them. I mean, I'm not going to harass them. And if they want to put $100 million in my fund, I probably won't even say anything. But the fact of the matter is, I'm on this planet not to see how I fit in with traditional assets and grovel for a 5 or 10%, but I'm here to sort of say, and I'll never have the assets that I would have if I in fact did that, like the managed future CTAs do. They buy it hook, line, and sinker. This whole idea that that CTAs have a 5 or 10% allocation to a traditional portfolio, and that long only is wonderful and perfect, even though they know better, or at least at some point they knew better. No, I'm here to create the perfect portfolio. Trend following is better. And I'm here to say, sell your stocks, sell your bonds. My God, man, what are you going to do for someone last year who had bonds? You had to be short those bonds. You can't be long those bonds. And that's going to happen in stocks as well. And trend following doesn't do well on these V bottoms when the market crashes and then rallies. It has tremendous failure, and it has multiple times recently not been nearly as good as just having unlimited risk and never getting out of these stupid stocks. But for me, I'm not going to submit to that and succumb to that short-term thinking and ignore that I know that you should trend follow your stocks. And the most pushback I'm going to get on trend following stocks comes from other trend followers. How stupid is that? How ironic is that? Because that is impact. They have a business model, and it's not about trend following. It's not about telling people what's the best. It's not about standing up and doing what you know to be correct, or even like mentioning it every now and then. No, it's getting those assets in your fund, and that's what people want. That's what they accept. And so what? I'll perpetually and permanently have a small amount of AUM, but I'm not going to give in, and I'm not going to play that game one bit, one time, one day, that we should add this. No, you should sell your stocks, sell your bonds, and trend follow them. Me or yourself or somebody else who trend follows, don't ever put your money in this long only crap, because it's always gone up. That's crazy. I mean, no, and I'm not ever going to agree to that. And I'm in a whole different game, and I'm playing this game mostly by myself, and it's not really a great idea to maximize my personal wealth. But I guess it's just
I think we're
just who I am.
in complete agreement. I think that allocating to assets and markets based on trend is superior to to buy and hold, whether it's stocks or 60/40 or whatever. I think trend is far far superior than those alternatives.
So, Jerry, I love the conversation this morning. Thank you. Sorry for my scratchy voice. In a world of horizontal lines, the guy who says vertical can't be seen or heard. His insistence on vertical just is more horizontal. So if you're gonna stake out the extraordinary, you're gonna have to deal with boatloads of normal, because the contrast helps define the extraordinary space you're after. I do look at this trend following experience for myself, the encounter, as philosophical first and financial secondary. But it so thrills me. And everything people have said today on the spaces and challenges that have been brought up, I've got a page of notes of rejoinders and wanna share abouts and stuff. It's so fulfilling. I am filled up and overflowing with appreciation for TF. I had one or two instances this past week I'll share and then stop. I'm a retail trader. I have no clients. I only do stocks, longs, long term. I have monies with Jerry and Dunn and others and Locor and Andrew, minor positions with the minor players. But I leave all that to the big guys. I just want an experience, as I've shared, to have my hands on these stocks. And I do it through Robinhood for $1 each. It's fractional. That's the minimum. There's no fee, no commission, no requirements. They give me good fills. They pay me a penny per quarter dividend, a 4% dividend on a 2% dividend stock. I'll take that. But the other day I had to close. I go in at 200 and I come out at 150. So I had to come out at 150 the other day, a trio of them. I'm like, I hate when I have to sell these. Josh, if you're upset, it's not trend following. It's something else. It's not trend following. There's no requirement in trend following for being upset. But I sold these because they hit 150s, and they were like, I sold them for $1.03, 3%, $1.07, 7%, $1.11, 11%. I'm like, wow, this is great. And I had a merger event, which required I do nothing but open the position and wait. I can't predict it. A merger, which went from $1 fractional for a $4 stock, and they merged out at $160 per share. I made like $3 on a $1 bet. So it's going to turn my September and my last 12 months into high positive. So that's just a piece of it. Thank you.
Yeah, so you agree, Josh, and I've tried to explain this because my understanding was that if you trade stocks or ETFs, and you can build a portfolio of stocks and bond ETFs and currency ETFs and commodity ETFs, there's really the size of the account can be super duper small because you can do these fractional shares, and just the way that stocks are. There's no contracts involved. You're just doing the shares. I mean, like on some of my positions, I might have on, 5 contracts of a future in this small ETF, but I probably have nothing less than 1,000 shares and in all the stocks, or even more, 5,000 shares. So people are always asking me like, how much money do I need? I can't trade because I don't have a lot of money. But I think when you're doing stocks or securities only in ETFs, and you can do fractional shares, wow, you don't need a lot of money to manage to have some fun with your trend following.
Yeah, and I have like somewhere between 500 and 600 positions on it at any time. It went down this past week, but that's what it does. Who cares what it does? I am I cannot it's hard to get away from this predictive centric thinking, just as it's hard to get away from the market being stocks only, or the market being the S&P, or the S&P being the benchmark for all trading. No, this is silly. I want a comprehensive approach. I want to own as many things as are liquid. I think it was Alp who said, or Absolute, I wanted to own as many things as I can that I'm able to own. And that's part of my nefarious scheme. Thanks. $600 in the portfolio. Plus, I have like 600 cash, which is making interest, 1.5% interest from Robinhood, and those dividends, which are just sweet. Jerry, can I talk about outliers for a minute?
Yes, please.
So I think that Jerry, you were introduced to this idea of outliers from Rich Brennan, and you can say if that's so or not, but I love it because yeah, we're hunting outliers, but not because we're able to predict them. But hunting outliers is the outcome of trend following and sticking to our rules, letting the profits run, cutting the losers short. Not too quickly though. And it just happens to be the thing. I mean, if I want to find the biggest bang for the buck without having to predict anything, I'm going to want to get something in terms of stocks and long onlys. I'm going to want to get something that's already going up, hence the 200-day entry. And then I'm just going to let it run up. I'm not going to be able to predict the outlier. I'm just going to be able to acknowledge it and have it and appreciate it and let it appreciate me. Outliers. It's the outcome of what we're doing, not necessarily the target, like predict. Thanks.
I think, when you're doing this data, when you're doing the back testing, and you're trying to find systems back in the early days when the first people were trying to, see how they could trade and see if they could take money out of the market. I'm sure they sort of, almost everyone has heard the term cut your losses short and let profits run from someone else. And so that could be a starting point. And then when you get in there and you start doing the research, you see the rules that work and the time frame that you have to utilize that works. And then over time, for us, that has expanded to be a longer term versus shorter term in the 80s. And then you start writing this narrative around it because you can't go through the whole back test with all the different sizing algorithms and entries, exit, stop loss, and how you calculate all the parameters and metrics. And so you come up with this way of shortening it and saying, well, in lieu of telling you about every detail of the back test, let's just call this thing trend following. And we let these profits run and take small losses, and 10 or 15% of the trades that we make all the money, and they're outliers. And so, but yesterday on the podcast, I was telling people that, frequently people will comment about, oh yeah, someone commented this week about one of our friends. He was just commenting and he's a shorter term trader, but he was just like making this comment like, how can you still be long the euro? It's not in an uptrend any longer. And I just think that's kind of dangerous thinking. That's not, because look, it all has to come from the back test. And any words wrapped around the back test are not as good as the back test. They're just words. And so it's not beneficial to look at things like what's in an uptrend, what's in a downtrend, what does this chart look like? I mean, we're humans and we're going to have these opinions. And I'm like, yeah, why am I still long the euro? Because it doesn't look like it's going up any longer. But these are just words that are meant to send us in the wrong direction, because we're long the euro because when we did the back test, it wasn't time to get out. And the back test said, if you handle all these trades with the same entry and exit rules and parameters, then you're going to still be long that euro in some of the systems that are the longer term systems. And over time, this is going to work the best. You'll make the most amount of money. But on this particular euro trade, you're giving back some profit, and it doesn't look like it's still in an uptrend. And so it's not a math thing. All those words have nothing to do with the back test, and they're just emotionally. But this is how most people do things. If it doesn't look like it's in an uptrend, then I should definitely be out. And that's not the way I approach it, or it should be approached. So even the word outliers is unnecessary. Like, I train my son how to trade. I have three sons, and one of them is very busy with fishing, fishing, golf, and well, mainly just those two things, fishing and golf. But he's the best trader. You ask him what's an outlier? No idea, probably. I don't know if I probably mentioned it to him, but he's the best trader because he does only what I tell him to do. And he only knows the rules. And he kind of gets it that you're going to take small losses and let profits run. But to some degree, not getting too deep into it makes him much more reliable and much more consistent and disciplined. And he may be the best trader in the family and not really know too much about the math and not know too much about what an outlier is and a non-normal distribution. All the things that I think are wonderful to know. And Richard, I give him credit all the time for deepening my understanding and knowledge of what is behind the trend following. And that's nothing but good. That's just going to make me better. But to some degree, if you get too much of that fancy stuff in your head, it can lead to less classic trend following. And so you never, if that's going to happen to you, then quit reading, quit listening, go back to just following these trend following classic rules: one entry, one exit, and a stop loss, and being disciplined and making the most amount of money your bottom line. I feel like I can have it both: maximize my performance and maximizing my intellectual knowledge and curiosity. And Richard Brennan has been a big part of that. I have two Riches, and both have had a tremendous impact on me. Rich, hanging out with Rich on these spaces and listening to him and his tweets and podcast is fun. It is so much fun. I really, really enjoy it.
Thanks, Jerry. And look, the reason why I'm big on outliers is that everywhere where I look around this natural world, the Pareto distribution rules. You see it everywhere. And what is actually the anomaly to me is the normal distribution, because you only see that in man-made systems. Like, you don't see it in the natural environment. You see the Pareto the single tree that grows the tallest, and all of the other trees are dwarfed. In every single system you look at in the natural environment, you see the Pareto distribution rule. You see that in wealth. You see it in who is the the Forbes 500 list. You see it everywhere you go. You bump into this Pareto distribution, and if people don't come to grips with what outliers are about, especially in the financial markets, it strikes me as bizarre.
I remember reading Cantab. Yeah, many years ago, Cantab was a larger CTA than they are. I think they got absorbed by someone else, and they would put out some really interesting papers. And I remember reading this one paper many years ago that basically just flat out said that outliers are a problem. They're a problem to get rid of, and it's just the sort of the traditional way of looking at trading and investing, that you don't want these outliers. You want to normalize everything, and it's just the sharp. It's more about the sharp and the traditional way that people measure return risk. And I was just flabbergasted because I had learned that outliers are wonderful and these are things we should embrace. and this is going to make all the money. And you have to handle them, it's what's so critical to take all the trades and handle them the same way. That is the definition of optimal, and that is handling them the same way each time. So if one of your systems always gets out at the 100-day low, then you better always wait until the 100-day low. And so I was pretty, this was really, really smart people that sort of are 99% of managed futures now that have come from a traditional background, but not left that tradition behind and gotten the light of trend following. They have merged the traditional and the PhD and the business school with a little bit of trend following, where the turtles came in not knowing too much, probably on purpose, hiring a bunch of people who were easy to teach and had nothing to add to the trend following. I was listening to, guys, there is a second Moritz. He is really an interesting fellow, and he was on the podcast with the main Moritz number one, with Richard, and he has a great background. And I don't want to mischaracterize it, but I was listening to Moritz Hayden talk, and he was this incredibly smart guy with all these degrees in computer science and math, but it did sound like he was able to not let that get in the way of being a good trend follower. And so these type of people are rare. They're pretty rare to be able to handle this knowledge without it getting them going in the wrong direction. So I was really enjoying listening to him on that podcast. In my book, both of them Ritzes are at the top. They're both incredibly smart, but it was really, you got a great partner there, Moritz number one.
Thank you. I know. That's great. I think he was actually on the space here just a few minutes ago. He WhatsApped me that he's in the gym, and rather than working out, I guess he's working out his brains by listening to us.
Jerry, I remember Seth Klarman said about value that you either understand it in 20 minutes or you never understand it in your life. Do you think that with trend following, it's something similar to that? Or can you go over too much understanding that will freeze you, or you will never get it?
That's a good question. Yeah, it reminds me of it's just something that I'm very curious about. Is it are they just kind of like denial, hard-headed, refuse to admit? It just doesn't suit their personality. And I have to say that I'm sort of fascinated by trying to understand the answer to your question. However, it does remind me of working with people over the years and how hard that is. Someone was asking me like yesterday, are you ever going to retire? And I'm like, no, I would never retire because I just have too much fun. And I stopped doing things that I didn't have fun doing a long time ago. It's one of the perks of my life is that now if there's something I must do, I hire someone to do it. And so I only put myself in situations where I'm enjoying myself. And, that's not totally true, of course, but I try to, and trading and watching the markets every day is something I really enjoy doing, and doing my own kind of stock research and tweaking my systems and talking to my research people. But one of the things that's I really never really enjoyed, and it really was a problem with having a successful business, is you really have to do a good job at being a boss and dealing with people and hiring the right people and firing people and dealing with people, and getting your team at a high level. I read this article once from Harvard Business Review called Hire Slow, Fire Fast. And I never did that. I hired fast and I fired slow because I wanted to think of myself as a good person, as a good guy. And it was just detrimental. You've got to get that team together quickly and not have your excellent elite people drugged down. And I was slow to fire. And I was always very curious as to why can't these people do better? Is it my problem? Is it my fault? Why are they doing what they're doing? Why aren't they at an elite status? Why aren't they trying harder? Is it their smarts, or is it their desire to work hard? I couldn't figure it out. And I eventually just thought, like, why should I even care? Don't even try to figure it out. It's just like in trading. You're going to get out of some trades prematurely. You're going to take that small loss, and it was the wrong thing to do. But you're throwing your fate with a systematic approach. And the systematic approach doesn't always perform correctly. It gets out of a trade when you should have stayed in. It stays in a trade when you should have gotten out. So you're just saying, okay, yes, this is going to occur. But if I have this same process on all the trades for the rest of my life, I will eke out these profits. And I think in the same way, you just have to have a rules and deal with it. And yeah, oh, my bad. I should not have fired that person. They were going to turn it around. Or I stuck with them too long, but this is how long I stick with people. And after a day or two, I should have figured out to get rid of them, but I didn't. And so I think in the same way, why should I even care about this idea? I know what's right. Why should I care? Why should I try to figure out why these people can't understand, why they don't like it, all their objections, why they don't buy it hook, line, and sinker like I did when I was 25 and I was reading articles out of the Wall Street Journal or random places trying to find information about trend following. I didn't need all the questions answered in a right way, in a particular way, all the formulation of how it works and why it works, all the perfect answers. I didn't need it, and I thought it was great. So I don't know. I don't think we should care. Screw them if that's where they want to live their life and they can't figure it out. And then I definitely have no evidence in my particular life that I should be very prideful on my individual intelligence level, and that I should sort of think extremely highly of myself as being this incredibly smart person. But maybe that's the answer. Maybe we're just smarter than everyone else. And you can have this book learning and you can have these degrees and you're not very smart. And there's more to it than just knowing the math and the science and the coding. That's why, C students have a lot of the money.
Well, I had a mentor that used to say that one of the highest, if not the highest, form of intelligence is just to do what intelligent people does, just copy them.
Oh yeah, I'm a big copier. I copy people all the time. I love copying people, but you have to prove that it works, and it has to become yours. You just can't copy people without understanding it and using it as an inspiration to make it better and fit in with your way of doing things.
Yeah, and it takes intelligence to recognize intelligence.
Yeah, that's true.
So I think that performance is largely a function of what people are listening for. Are they listening for quick and easy? Are they listening to understand? Are they listening to be right? Are they listening to gain favor, look good? And then the other thing that has my attention here is that, as far as I can tell, and this is a direct steal from Chilean biologist Umberto Maturana, who suggests that human beings only learn from the inside out. You can't force anyone to do anything or to learn anything. They come upon it themselves. So I love this notion of how do you create the environment for somebody to discover something of value, discover it for themselves. I think, Jerry, when you're talking to the naysayer bunch, the 60-40 crowd, the sharp adherents, the S&P-centric views of things, they have a particular way of seeing it. So how do you invite them to discover these other things for themselves? I know that I only heard about this thing maybe 2 years ago when Covell was on a podcast and he said, we just look at price. I'm like, what? Just price? None of the fundamental stuff I'm paying for?
Yeah, well, one thing is that there's another cliche or quote out there that I can't remember exactly what it says, but it's something like, ideas never go away. The people who promote them just die. So, so you yeah, so trend following, maybe my strategy will kind of go away when I die. My way of looking at it will, I'll have to die. Richard and I will have to die, Moritz, and then finally it'll go away. But but it's easy for me to have these extreme perfect views, like in just the perfect world view of how things ought to be, because I've already built my business and I'm in the later stages of my career. And so there are people out there who are starting and they can't not pay attention to good ideas that are not perfect. And so I and it's not just because, Adam's on the spaces, but I like Corey and I like what those guys have done and Standpoint. And it's great product. I'm jealous. I wish I would have come up with it and done it myself. But yeah, it's easy to have a perfect and a pure point of view when you're at the end of your career, and you know people need to run businesses and make money and get AUM and give people what they can handle. Like I love Eric's quote, which is, "I'm trying to get people to do what they should do," or something like that. And that's a brilliant way of looking at it. But we can't all be the same. You don't want me to be the same. I'm different where I am in life and what I've learned. And so, I'm not doing anybody a service by saying, "Oh, okay, I'll do one of those return stacking or um, managed futures plus index funds as well." They're done. I can be the extreme, all grumpy, crotchety old man on the front porch screaming at the kids to get off my lawn, because that's a role that I should play. And there's a lot of people out there who love trend following as much as I do, and I don't mean to insinuate otherwise. But I do think I do it mainly just for the fun of the debate, and that's why I embrace all the tweets and I'm searching on podcasts and tweets, for something I can kind of like debate or argue about minor little parts. But it is because I do think it's kind of fun um, to do that.
Jerry, I like Moritz's explanation as to why we should be paid fees by investors, even when we're trading something that's relatively simple. And I think it's people who have gone full circle, who have been on the bottom of the mountain, went to the top of the mountain, and then gone to the bottom of the mountain on the other side, that can be as proper gatekeepers for people who haven't done the mountain climb. And even if you come back to some simple conclusion at the bottom of the mountain on the other side, the value that you're providing to clients and investors and people who haven't done the climb is that you are the gatekeeper and your conviction is strong because of them mounted climb and going back down. And basically you understand how each and every addition of complexity or bells and whistle that other people are marketing and whatever, you're aware to the cost of adding it. Whereas a person who hasn't done the climb may succumb to such marketing or to such pressure, and they may be impressed by the intelligence and the shininess of the new thing or the new algorithm or the new math. So ultimately, what investors are paying experienced fund managers, even though their strategy is simple, is actually a winning strategy for a amateur investor would be to find an experienced trader or a fund manager with the simplest strategy possible. And that's the winning strategy, because after a person has survived for so long and come to such a simple conclusion, that means he has eliminated so many things on his way up the mountain, on the way down the mountain, that no amateur investor or a younger trader can provide. So when people say, "Oh, this is a simple strategy, therefore you should not be charging a high fee," I agree with Moritz that the fee should be proportional to the experience and the expertise of the gatekeeper who's running the strategy, and not proportional to the complexity of the strategy.
A lot of these things you just have to go through yourself, and it's just going to hit people different. I'm kind of thankful that initially I was told, like, okay, your two biggest problems or two biggest issues are going to be not following the system and then trading too large. And so it's worked out best for me that that's exactly what happened to me. I did not heed that wisdom, and I did trade too large frequently, and which impacted my ability to be disciplined, and it impacted. But sometimes I wasn't disciplined, and I wasn't trading too large, so I can't blame it on that. And then as we in our first 10 years or whatever, 7 or 8 years of existence, we made money every year. And so even though the classic type trend following, certainly during that period, had some really unfortunate drawdowns, just making money every year, which is something I think is the ultimate, what sort of this classic approach gives you. It is very consistently profitable on a trailing 12-month period, as much or more than the dynamic position sizing. It's kind of an ironic thing, but that's another subject. But we've done that research, and letting profits run and letting the possibility of the profits turn into small profits or losses actually increases your consistency over like a 12, 18-month period versus more of a dynamic position sizing, correlation, volatility management. So, I lost my train of thought now, of course, but yeah, doing this type of trading, and I also would get away from that. That's another thing that I did too. After this 7 or 8 or 10 years of making money every year, we just said, hey, we got to get better. We got to improve. We didn't say, hey, keep doing the same thing. We were reading what other people were doing. Hey, add this thing, add that thing. And so then we would get off a little off track then as well. But it is good for me, my personality, that I never was rewarded for this lack of discipline. I never had a period where, oh, I got lucky and I made money, even though I wasn't really following the system, or I got away from more the classic approach. No, it was always punished. And so as painful as that was, from my net worth point of view and losing clients and not having good relative performance because I wasn't as disciplined, it really forced me to get right back on track doing the things that I already knew from day one. I knew how to trade. I knew what was right and wrong. And from day one, I wasn't able to do it. I knew how to live a healthy life and diet and fitness, but I was really, really overweight until I was 42. So the knowledge and having this knowledge and talking to people and seeing people and having people tell you about their experiences was not enough for me. I had to do it my own way and suffer my own way. And we're all impacted by our environment and our partners and who we're dealing with. Not everybody has the luxury that I have to act like I don't have to answer to anyone.
Hey, Jerry, regarding the consistency you mentioned, not having a losing year, do you have a sense that the number of required markets to trade is increasing over time to satisfy that condition, to not have a losing year? So what I'm asking is, let's say you could achieve not having a losing year 20 years ago by trading 30 markets with a set of parameters and systems, and but that 20 years later that's not true anymore, and that you would probably have to go to 50 or 60 markets to achieve the same level of consistency, not to have a losing year. Do you have any sense of deterioration along these lines?
I don't have any sense that there's been a deterioration. And obviously, the more markets you're trading, the more likely that you're going to have a positive period. I totally agree with everything that Moritz was saying about Yeah, I mean, if you have this positive game, it doesn't have anything to do with trend following at all. If you have a positive game, the more trades you can push into a shorter period of time, the more likely that your edge is going to manifest itself, and you're going to have a positive period. So if you traded a million markets, I mean, I don't care what system it is. It doesn't have to be trend following. It can be whatever has an edge. If you had a million markets and you could cram them, especially with this long-term trend following, it gets even more necessary because back in the day, not only I had fewer markets, but I had shorter term systems. And so that's a big impact. Now I have a lot of markets, but it's offset by the fact that the systems are super long term. So that you need to trade, that makes it even more important to trade more and more markets just to stand still and not go backwards. Now, if you're able to trade a million markets and you have this edge and you're cramming more trades into the same 12-month period, then theoretically you should make money like every day or every year. Now, of course, you've got the correlation and the real diversification issues as well. But once again, you got the hunting outlier version of that as well, which offsets some of that. But
No, I understand that. I mean, that's clear. We already concluded more markets always produces a smoother curve, better return to risk ratios or drawdown ratios, and whatever. What my question was whether that edge that you talk about is deteriorating. So whereas the edge, if the edge was bigger 30 years ago, where just 30 markets could give you a certain level of smoothness or consistency, so to never have a losing year, 30 years later, whether 30 markets is enough to give you the same level of consistency that you had 30 years ago. So if the edge is deteriorating, then you need to pack more diversification to have the similar level of smoothness and consistency. So whether you noticed something like that, that was my question.
yeah, I haven't really noticed that. But recently we ran a back test and it had problems because of, markets come online and over time. And so you start with 30 markets in the 70s or whatever, or 20, and then now you're up to hundreds. And it depends. And if you're going to include single stocks, which ones you're going to include, how robust are your rules for including stocks, and which ones you include. But anyways, I've said this before. We went back to 1977 with one of our systems, and had a win, and we had no losing years with the current up until last year, and then through last year. And so, but we had a bunch of years with less than 1% profit, so those could be easily negative. I'm just saying that it is kind of funny how incredibly consistent these longer term systems are. So essentially, what the world or the market is saying is, if you're willing to sit there and literally wait for that long-term breakout exit to occur, at least 100 days lower, at least, if you're willing to give back all of that profit on cocoa, because the 100-day low, I think it may turn into a losing trade. If you're willing to do that, then you're going to overall have a very consistent return and make more money than everyone else. I stand by that because that's what the research shows. And now, so historically, that's what it shows. Is that going to continue in the future? But I do think that that's a fair trade-off. If you're willing to endure the most pain and suffering, and when people ask you about it, all you have to say is, this is what's worked in the back test, and I promise myself I'm going to follow these specific rules, regardless of how people are going to laugh at me and clients are going to leave me, then okay, if you're willing to do that, here's what you get in return. Very consistent performance. I think and when I first brought that up with Richard and Niels, I think I was on a podcast with Niels, and then the next week he brought it up with Richard, and they were both kind of like, what the hell? That doesn't sound right, but it is right. And I mean, we did this research 20 years ago and every year since then. And it's pretty amazing that that's what you get from trend following. And that's why I keep forgetting that that's one of the big benefits of trend following. A normal person who's just a normal retail client they completely would understand that and think that's a great thing. That's a great risk metric. You mean I'm going to make money every year? That's the greatest risk metric. I would never say that for compliance reasons, but it's very consistently making money as 12-month trailing return is in the, I don't know, 80s or 90s percentile. So, but no, so the more training and math and PhDs you have, that sort of real world thing kind of goes away. Oh, it's about Sharpe. Oh, it's about volatility, blah, blah, blah. So this is, it's a really unique thing. It's very difficult to do this research and replicate research, especially when people have nuances built into their systems and do things slightly different. And we include single stocks, and it does definitely matters which single stocks you include. So another thing that trend following suffers from is nobody really likes to embrace anybody. If you dig deep enough, you'll start disagreeing with your best friends about research and how they did it and the conclusions you get. But as Richard has said many times, and one thing he said was long-term track records, long-term verified track records are the best. Is anybody still here? I think I may have lost everyone.
I'm still here, Jerry. I'm caught up in a Twitter responding to Adam, who's also here. I think Adam Butler. He's here, but he's tweeting me at the same time, and I'm trying to sort of do both things. I'm going to stop focusing on Twitter, and I'm dedicated to this space now.
No. I got curious, and I started reading some of these tweets, and I invited Adam to speak. But we need Adam and Richard to come back next week and do a proper discussion of all of these topics that you're tweeting about. And trust me, I've done this a million times.
Adam was just hauling me over the coals with a bit of sloppy research I did today, but I just wanted to get a quick and nasty out. But yeah, I agree with Adam. However, I think the principle that I was trying to suggest was the important thing.
All right, well,
I'm sorry I didn't get the invitation, guys, or I didn't see it. I'm actually not a real Twitter Spaces pro. So I did hear a beep a few times, and I thought it was new people joining the talk. So sorry about that.
No problem.
Yeah, stop tweeting me, Adam.
Yeah, that's right. I'm proving to be a major distraction. Appreciate your attention.
All right, well, try to make it next week, and we'll let you and Richard go at it and sort this stuff out for us. In the meantime, I have birthday responsibilities for my lovely wife, and I'm really excited about the birthday cards. I did a really good job on the cards, and obviously the present. But and I'll beg for forgiveness for spending 2 hours with you guys. But anyways, it's fun being here. Fun to be back. Thanks for being here, everyone. Talk to you next week, same time, 7 a.m. Eastern, every Friday. Have a good week.